Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. In Japan, the equity market is breaking to fresh record highs, and these gains reflect expectations for more fiscal spending as well as a cut in the sales tax on food items. All of that comes after Prime Minister Takeichi's snap election victory over the weekend seemed to give her a mandate to make economic change. Meantime, here in the States, equities recovered, especially those software stocks, following last week's sharp losses. Now, at the time, the spotlight was on how AI could undermine various software businesses. And not surprisingly, many of those shares were punished, although last Friday the mood began to shift, and it continued today. The IGV software ETF picked up 6.8% over the last two sessions. For a closer look, I'm joined by Ross Mayfield. He is investment strategist at Baird. Ross is on the line from Milwaukee, Wisconsin. Thank you for being here. What did you make of the bounce in software shares today?
Well, I think generally I'm of the view that there might be some disruption, and there probably will be, but I don't think that most large companies are going to rip their tech stack out in favor of AI tools overnight. I think the selling is overdone, and this is when I would be kind of legging into some of these names, even if the recovery could take some time. I mean, these charts are pretty beat up right now.
It was interesting today. Goldman Sachs noted that hedge funds had piled into short positions on the notion that we were going to see AI disrupt various business models. And I'm wondering whether or not some of the positivity that we had today may have been tied to some short covering. What do you think about that?
Yeah, I think so. I mean, this is, the software names were by a lot of metrics at their most oversold as they'd been in decades, probably since the dot-com bubble. And so anytime you get that kind of, violent shift in the markets, you're going to get some technical selling and some short covering. And I think that, this could be an oversold bounce here. I think you could see a resumption downward, or at least kind of some sideways trading as these names carve out a new base. But again, if you're investing with a year plus timeline, I just think that the selling is overdone, and you've got a lot of babies thrown out with the bathwater. There are a lot of companies, that are software adjacent that have been sold, but have really diversified businesses with big entrenched user bases.
We had a very interesting development today from Alphabet. The company is going global now, is insofar as financing ambitions for AI. Alphabet is set to raise about $20 billion from a U.S. dollar bond offering. And this offering was more than 5 times oversubscribed. At the same time today, Alphabet began pitching what would be the company's first ever offerings. This is a debt offering, one in Switzerland, the other in the UK. What does this speak to when you have one of the hyperscalers going into the credit markets to try to raise capital to build out AI infrastructure?
Well, it changes the narrative on these companies entirely. I mean, for decades, the story around, the big tech companies, FANG to Mag7 to all the different acronyms in between was huge free cash flow, low debt, businesses that just print money. And then you can, if you're Alphabet, you can plunge all that extra cash into moonshots like Waymo. These businesses are fundamentally changed. They are now asset heavy. They are tapping debt markets. It doesn't mean that they're bad investments, but it requires basically a whole new way of thinking about the big tech companies at the top of the market, from asset light to asset heavy, and what that requires and what that means. But it changes how investors who have leaned on these companies for decades, a change in how you have to think about them.
So does it create anxiety for you to the extent that if you were long, let's say, a name like Alphabet, that you would try to reduce your position slightly?
I don't think I would take it that far. I do think it raises the stakes a little bit. So, we keep a really close eye on broader credit spreads and, make sure the bond market is well behaved. But, I think there's an interesting dichotomy in the market right now, which is that if you look at the software sell-off and you believe that even some of it is justified by incredible potential of AI tools, whether it's Anthropic or Gemini or all of the above, then perhaps the level of spending that Amazon and Alphabet laid out last week is justified. And I would be, buyers of the names that, again, are kind of selling the picks and shovels and building out the infrastructure to, keep this trend going. So it requires extra due diligence. But I would not be, selling a company like Alphabet at this point in time with what I think is an AI, trend that's still in the early innings, quite frankly.
So we've seen enormous volatility recently in a number of asset classes, and that would include Bitcoin. We saw a bit of a rebound from the recent sell-off today, and we kind of fluctuated on either side of 70,000. How are you feeling about the crypto space?
Well, crypto is very narrative driven. I mean, like any asset that doesn't produce cash flow or have like a real industrial use. It doesn't act as a currency, particularly in developed markets. It trades on narrative, and over the last 3-4 years, some of the predominant narratives have been really beat up. It was not a good inflation hedge in 2022, and it has not really acted like a store of value to hedge geopolitical or debasement risk. It's not a good sign if as the digital gold for a modern era, it's going down while real gold and silver are going up and to the right. And so the complete split of those two assets, I think, really hurts the narrative that crypto and Bitcoin in particular is this store of value that can be counted on. Now, anyone who's watched the space for a while knows that this sort of volatility is not uncommon, but every crypto bull and bear cycle we go through, as institutional adoption picks up, and as these narratives get beat up, I think there's going to be more and more behind the demand for use case and for what is this. And so I'm somewhat of a skeptic. It's just kind of entrenched in me to be a little skeptical of this sort of stuff. But I do think that narrative being so beat up over the last couple of months is concerning as we go forward.
We also had news today that the privately held firm Jump Trading is set to take some small stakes in both Kalshi and Polymarket. This would be done in exchange for providing liquidity on these prediction market platforms. How do you view the prediction markets overall?
For financial markets, for investors, it could add some level of volatility to markets, if these platforms really get up to scale. I think it's probably not too big of an issue for broad investors at this point. It probably says more about society than it is an indicator for financial markets. But anytime you have a lot of interest in leverage in the kind of meme stocks, and I think that these kind of prediction markets and event contracts start to fall under that umbrella of retail getting really creative with ways to try and hit it big. Maybe even crypto falls under that umbrella. It adds a level of volatility and a level of systemic risk that is hard to price because they're so new. But it's not a concern, I think if you're just an investor in a 60-40 or someone who has kind of a diversified portfolio. Now, what it says about the state of the world is maybe a different conversation.
Change gears very quickly here. Talk a little bit about Japan, because yesterday we had a pretty powerful rally in the equity market in Tokyo. That was after Prime Minister Takaichi managed that historic landslide win in the snap election on Sunday. And we've got, as I speak to you, the Nikkei trading at a record high. If you had to look at a market offshore, would you take notice of what's happening in Japan and maybe put a little cash to work?
Absolutely. Japan, Korea, there are a lot of stock markets around the world that are acting like leadership and leading this global bull market. I think of all the asset classes, U.S. Investors are probably the most underweight international after 15 years of underperformance. I think U.S. investors should really consider adding to international here. I think the weaker dollar story has legs. There are structural drivers in not just Japan, although that's a great story and a great looking chart. But in other markets around the world, I think international is a really interesting place to be right now. It's a kind of a natural hedge to the tech-centric U.S. markets. And I think it's just frankly underowned in the U.S. So Japan looks great, but I would be adding to international more broadly as well.
All right, Ross, thank you so much. We'll leave it there. Ross Mayfield is investment strategist at Baird, joining from Milwaukee, Wisconsin, here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. The U.S. employment report for the month of January is due on Wednesday, and today the director of the National Economic Council, Kevin Hassett, said softer monthly jobs gains are likely in the coming months as labor force growth slows. Today, it was anxiety about the jobs data that helped to weaken the dollar. We had the Bloomberg Dollar Spot Index falling 0.6% in New York trading. And that's where we begin our conversation with Carie Li. She is the global market strategist at DBS. Carie spoke to Bloomberg TV host Shery and Avril Hong.
Where are we in these conversations and debate around the dollar debasement trade?
Yeah, I think over the past two sessions, the decline in the U.S. dollar actually was driven mainly by the resumption of this debasement trade. But in the short term, on the tactical horizon, actually, we think the dollar index may still find some support around 95 to 96. Because first of all, we've seen the latest data like ISM manufacturing and services index actually point to a still resilient U.S. economy. And then last night we've also seen the quite resilient U.S. stock market. And because of the still solid equity market and economy, it feels like the Federal Reserve itself may not be as dovish as expected. If this is the case, then the yield advantage itself may also help to support the U.S. dollar around the 95 to 96 level at this moment.
How closely are you watching who becomes the next chair of the Federal Reserve? We just got the latest comments from Kevin Walsh talking about how he wanted to transform the institution.
Well, for the upcoming Fed chair, actually, we think he is going to still protect the U.S., the Federal Reserve's independence, which is actually not a negative factor for the U.S. dollar. But, however, at the end of the day, we've seen in the longer term, the U.S. dollar itself may still have a structural moderate downtrend, which has already formed since 2022. The start of Russia-Ukraine war, because this is not about the next Fed chair, but more about the U.S. policy uncertainty actually shakes the U.S.-led world order, and the market is also still concerned about the U.S. fiscal sustainability in the long term, which probably the reason why we will see this on and off debasement trade still weighing down the U.S. dollar in the longer term.
Carie, talk to us about the other side of the dollar trade in Asia, specifically for the renminbi. We saw a bit of firmness following Bloomberg reports that China has told financial institutions or banks to reduce their exposure to treasuries. And this is not because of geopolitical maneuverings, to be clear, but more because of paring back some of the risk in markets. As investors rethink what the U.S. assets are going to look like this year, what are you seeing in China?
Well, in China, we've seen the PBOC always talk about renminbi internationalization, and they also try to transform the economy towards a growth, consumption-driven growth model. And this probably needs the renminbi to strengthen a fair bit. And in the meantime, we've also seen quite a fair bit of capital inflows as well as a record high current account surplus, all supporting the yuan. And more importantly, the PBOC has set the dollar CNY daily fixing rate lower and lower gradually. Firstly, below the 7 mark and now towards the 6.95 level. It feels like the PBOC does allow some further strength in the renminbi. And if we look at the renminbi index, actually it's still below its 5-year average, which means that the catch-up play for the renminbi still has some room to run. So we do do expect the dollar CNH to fall a fair bit towards the 6.9 level. And then for the next step, whether it will go to 6.8 or even 6.7, it depends of the next move of the US dollar. If the dollar index is trending lower towards 94, and if there is signs that China's economy is improving further, then it's possible for the dollar CNH or dollar CNY to try lower towards 6.8 or even 6.7 in the rest of this year.
Carie, what about dollar Japanese yen? Is the verbal intervention we've been getting of late going to be enough to keep things down?
Well, actually, I think the yen's strength over the past session is a bit surprising, but it's mainly driven by the retracement in the US dollar as well as the verbal intervention. I think the market probably is still concerned about another round of coordinated rate check by the US and Japan. But as long as there is only verbal intervention and there is no real intervention, then probably the market's focus will shift back towards the concerns about the fiscal sustainability under Takaichi government. If that is the case, then probably the Japanese yen is not yet out of the wood. The dollar yen will still find some support around 154.5 before 152, and then the risk is still tilted towards the upside, probably towards the previous high around 159.45.
Yeah, that was achieved around mid-January, right? That 2024 low against the greenback. What are we expecting in terms of the Bank of Japan? Could we see accelerated rate hikes given the weakness in the yen?
Well, in terms of BOJ, actually, our expectation is for them to hike once more this year towards 1%. But there is also scope for them to hike further in the later part of this year or the early 2027 if the Takaichi government's upcoming fiscal expansion is going to support the economy and support the wage growth. And if that is the case, then probably for Japanese yen, they may also find some scope for further interest rate hikes.
That is Carie Li, global market strategist at DBS, speaking to Bloomberg TV host Shery and Avril Hong, giving you the conversation right here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.